we're getting on to independence and objectivity. Wait, you know this stuff. Of course you know this stuff. This is from the CIA Part 1. And you'll see that this is kind of a reminder, but there are quite a few questions on the CRMA historically that have actually been about this content. So this is a reminder, but it is very important both for the exam and for your general understanding as an internal auditor. I wouldn't usually go through things that are part of the CIA again, but I really think that if you want to answer the CRMA correctly, I think it's useful to have this kind of a revision. So here we're looking at the internal audit requirements for independence. And it's important in the CRMA for the reason that the questions will often tell you, are you independent and objective if you are doing certain things in risk management? And we'll understand the roles of these. But I think it's important to get a revision directly about independence and objectivity first. So I'm setting up the scenario. We have a board and we have internal audit. What are the requirements for independence? We need an appropriate internal audit charter. Why? Because an internal audit charter gives us our mandate. An internal audit charter gives us our hierarchy, our dual lines of reporting. It really is the fundamental basis for independence of internal audit. Freedom from interference. Freedom from interference means that you can do your job objectively. Remember the link between independence and objectivity? It is extremely difficult for you to be objective if you are not independent. In fact, if you are objective and you are not independent, then you can face a lot of interference and pressure. And that can really make a job as internal auditor very unpleasant if you're asked to, for example, modify your audit results. So freedom from interference is a condition for independence in an internal audit department. And for an internal auditor to be objective, well, of course, you need to be objective. So it's much better that you're independent, which allows you to be objective without risk, to your own career, that is. Access to information, people, and resources. Let me just put the last one, a pin on the last one, which says that internal audit needs appropriate resources to be able to carry out its internal audit plan. Okay? So that means we first determine the plan, then we present resources for approval by the board. When they've been properly approved, it allows us to carry out our internal audit. So resources including human resources, but also, budgets for travel or budgets for consultant, so that we can actually carry out the plan. For independence, you need no undue scope limitations. So that means you should be able to check anything that you need to be able to carry out the plan. I would say that there are some places where, well, it might be reasonable for you to not extremely easily have the information. So, the information about salaries of your different colleagues. Every time that I've been asked to, look at salaries, I've said, okay, but I want extra assurance that I can actually look at people's pay. I want to make it extremely well defined that this is for an internal audit. I'm not going to let anyone on my team directly ask for salaries, without my approval as chief audit executive. And I would usually get an approval at audit committee level from someone, sending directly to the head of HR saying, okay, we need to look at salaries, but this is extremely controlled. So this is the exception to the case where you really need no undue scope limitations, and you should be able to see every single part of an organization without question, as long as it's for audit purposes. Administrative reporting line to senior management. Remember we said that there are different types of administrative reporting lines. You can have them to the CEO, to the CFO. If you have one to the CEO, it allows you to have very good coverage of the company, but of course, CEOs are pretty busy. If you would have, say, a reporting line to the head of accounting, and you laugh, but it does exist, and the head of accounting is not part of management, not necessarily a CFO, then, well, you wouldn't necessarily get a very good coverage of the business, and you might get pressure to only cover, say, the accounting aspects, help off the external auditors, help do, purely accounting control rather than something else. And same thing, I've seen internal audit being under the head of risk management. I've seen internal audit being under the head of, compliance. These are not the ideal structures. You need to report to someone under management. And appropriate safeguards are in place. For instance, you should be able to audit something without problem if you have already worked in a certain department. Then you would not necessarily be very objective if you need to review that work again. If you are, say, reporting to the head of compliance, not the best structure, well, there should be safeguards so that you do not get pressure to give good opinions over compliance. Understand that? So maybe for that report on compliance, you'd report administratively even to someone else. This is just some examples of safeguards, but it really depends on the situation. Functional reporting line to the board. This is very important. As internal auditors, if you want to be independent, independence means being independent from the business operations that are managed by management. So you need to be independent from senior management unless you have a very twisted internal audit charter. You should really be able to report freely and honestly directly to the board.